The other thing that you have to know, because I know I'm going to get some people saying, my CPA told me I can't do that. Hey, what's going on, real estate investors? My name's Hayden Crabtree, or even if you're not a real estate investor, this video is for you, because what we're going to be talking about is how real estate investors can legally not pay taxes at all or drastically reduce their taxes. So let's say that, this is you, right? And let's put a smiley face on your head. And let's say you make $100,000 a year, okay? Now, let's say that you I live in Georgia. I think our state tax is 6%. And so this is state tax. And we also have a federal tax. So in the federal, you're actually going to pay it on a tiered system. And guys, I'm not an accountant. I'm not a CPA. This is not tax advice, but I just want to show you effectively how this works. Effectively, on the first $10K that you make, right, you're going to pay 10%. From $10,000 to $41,000, you're going to pay 12%. So up to $40K, you're going to pay 12%. From $40,000 to $90,000, okay, you're going to pay 22%. Okay, so let's say on the federal level, you're not going to pay 22% on the whole $100,000 you make, but what you are going to pay is you're going to pay $4,800 up to this point, $4,800 up to this point, and then you're going to pay 22% of $10,000, so $2,200. So we'll say that you're going to pay, another $6,000 here, right? So you're going to pay a total of $6,000 to the state and $6,000 to the federal government for a total tax bill. So this is an effective 6% tax rate. So the total tax bill here is going to be $12,000. So you're paying effectively a 12% tax rate on the $100,000 that you earn. Okay. Now, if you're a CPA, you're watching this, and I got this a little bit wrong. I might have got the numbers wrong, but I just want to show you, for example, how this works. Okay. So let's say that your tax bill is $12,000. The taxable amount, the amount that you are getting taxed on, is this $100,000, right? We are worried solely about this $100,000. Now, you can do certain things. We have a taxable amount equals $100,000. Okay. Now, we can do certain things, like we could buy a home, and we could have the mortgage interest. Let's say that we, pay $6,000 a year. Now our new taxable amount is going to be the $100,000 minus the $6,000 to give us the $94,000. Okay. Now remember, the $94,000. Again, we're going to pay now just 22% on the $4,000 over the 90K, okay? So does that make sense? So really what we're saving from our actual tax bill, the tax bill again being right here, $12,000. If we brought in the $6,000 of the mortgage insurance, we're only really saving 22% of that, because that's what tax bracket that's in. We're saving 22% on the federal level and then 6% on the state. So we're saving a total of 28%. 22 plus 6 comes out to 28% of the 6,000. Now, 28% of 6,000 is $1,680. Okay, so we were paying $12,000 in taxes. We'll take out $16,080. Let's round up to $2,000. Now we're only saving or paying $10,000. So we saved $2,000 in taxes. That's at a high level overview, and again, I'm not an accountant, of how all of that kind of process works out. But let's talk about why that's important, because we had to actually pay that mortgage insurance. That's $6,000 we put out of our pocket. It saved us $2,000 on taxes. So really, there's $4,000 of actual expenses. It's not like, there's that funny thing from Schitt's Creek, which is like, it's a write-off, right? Like, you actually still had to pay for that. So it's not just free money in any way. But let's talk about how real estate investors do get free money. So let's talk about if I was a real estate investor who owned rental property. Okay, so again, let's go back to the scenario where you have $100,000 of income. Okay, so you make $100,000, and this is the taxable amount. So let's talk about the rental property side. So let's say that you go out and you buy a rental property for, let's say, $300,000. Okay, now out of this, of course, it's going to sit on some land. You cannot depreciate land. Okay, we'll talk about depreciation in a second. We'll say this is 10% and this is 90%. Okay, so that means out of this $300,000, you can not depreciate 10% of it, so 30 grand, but you can depreciate 90% of it, which is $270,000. Now, I keep saying depreciate. What does that mean? Depreciation is this word by the IRS in accounting, which effectively means it goes down in value. Now, realistically, we know that rental properties appreciate, meaning if we buy this thing for $300,000 in 10 years, it's probably going to be worth $400,000. That's what appreciation is. But the government says, hey, in year one, let's do a different color here. In year one, this thing is worth $300K. Okay, in year two, this thing is worth $290K. In year three, this thing is worth $280K. Okay, so really the government thinks that this thing is going down in value by $10,000 each year. So if we were to buy this rental property and we were to the government's eyes goes down by $10,000 each year, which this is a good example because the schedule for residential real estate is 27 and a half years. So if you had a $270,000 depreciable property, meaning the actual building itself, right? The actual building is depreciable. The land again is not. You have $270,000 over the 27 and a half years, that's about $10,000 a year. So let's say that happened, and then let's also say that this property, right, we bought this as a rental, so it's going to cash flow. So let's say that the cash flow on this property, and let's just try to do that in this little box over here. Let's say that it brought in $20,000 of rent, we paid $5,000 of expenses, and we cash flowed $15,000 a year. Simple example, right? So really now this $15,000 here, we're going to need to add this in. So we made $100,000 plus we had $15K of cash flow, right? So that brings our total taxable up to $115,000 taxable, right? Wrong, because here's what's actually going to happen. We're going to take this $10,000 loss from depreciation right over here in year one, and we're going to take out $10,000. So now the government is really only looking at our taxable bill like we made $105,000. Okay, so we actually made $115,000. Let's do this in green so we're all clear. We actually made $115,000, but the government is only taxing us on $105,000. Okay, we actually made $115,000, but the government is taxing us on $105,000. We made $10,000 tax-free, and that's one of the ways that real estate investors win. Because remember, in the last example, $90,000 you're getting taxed at 22%, and that's up to $170,000 when you start to reach the 24% tax bracket. But we have the federal or the state as well. So 28%, again, $10,000, that saves us $3,000 in taxes that we're not paying taxes on that we should have. But this isn't really where it gets good. And let's do this example, or let's talk about this again, okay? So we'll leave the $15,000 a year of cash flow. That's not going to change, so I'm going to get rid of that. And I'm going to get rid of all of this. Okay, and so now what's really great about this, and this will save me on a $55,000 investment that I made, it's going to save me this year $25,000 of actual taxes paid. Okay, so I made an investment in 2021 I invested $55,000 of cash. This year, it will save me, not from a depreciation standpoint, but actual money I don't have to pay, $25,000. So I regained half of my investment this year in just taxes saved. And what this is called is accelerated depreciation. Because again, we were thinking here that we're going to depreciate this property over 27 and a half years, which means year one, year two, year three, year four, all the way down to 27, we're going to take 10 a year. But what accelerated depreciation does, instead of having to wait all these years, what accelerated depreciation does is it just takes all that depreciation and zips it into the first couple of years. Okay, so we're accelerating the depreciation. How we do that, it's fully approved by the IRS, is you can go into a building, a house, and you can say, this roof, this roof really isn't going to last 27 and a half years. This roof is only going to last 10 years. So what's the value of the roof? And let's divide it by 10 years. And then, these electrical components, they're not going to last 27 and a half years. They're only going to last 3 years or whatever the amount may be. Now, realistically, all this stuff can last a really long time, but the government put out a schedule of how quickly you can depreciate certain items. So instead of taking, again, like 1/27th of the depreciation here, let me clear up a little bit of room, or actually what I can do here is all of this. Instead of taking all of this over 27 and a half years, guys, what I can actually do is I can come in and I can move all of that depreciation in, again, I was taking 1/27th a year, which takes 27 years. I can take all of this and I can take almost, we'll say 1/3 of it in year 1. And I could take 1/3 of it in year 2. And I could take, I can't take another third in year 3. It'll be stretched out over the following years. But realistically, instead of taking $10,000 a year, what this is going to allow me to do is take 1/3 of $270,000, which, if my math is right, $90,000 in year 1 and another $90,000 in year 2. So let's take a look at what would happen if we took $90,000 on this investment. Again, we're going to come up here to our taxable income and let's subtract out $90,000. So now if we have $115,000 that we actually made and we take out $90,000 of depreciation, in the eyes of the government, we're only going to have $25,000 taxable. Okay, and if you remember, we're only paying 12% at that rate to the federal and 6% to the state. So realistically, on this $25,000 tax bill, we're only going to be paying 18%. So $25,000 times 18% is we're only going to pay about $4,500 in taxes. Okay, so what did this allow us to do? It allowed us to make $115,000 and only be taxed like we made $25,000. So we made $90,000 without paying taxes on it, right? And the cool thing about this is that we saved from the higher tax brackets rather than the lower tax brackets. The depreciation applies to your highest taxable amounts first, and then it works its way down to the lowest taxable amounts. So that is how, from a high level, real estate investors can save a ton of money in taxes. And guess what? This depreciation didn't cost them anything. They were making a good investment in this property right here. Anyways, they were happy to do it, and this depreciation is a side benefit. Now, if you want to be able to take advantage of the cost segregation studies, you'll have to pay a certified professional to do that for you. It's going to vary on the type of property. It's going to be anywhere from $2,000 to maybe $8,000, depending on how big the property is. But that, from a high level, is how it's done. The other thing that you have to know, because I know I'm going to get some people saying, my CPA told me I can't do that. Your CPA is wrong, okay? They're just not a real estate investor CPA. But here's the other thing that has to happen for this to be true, okay? You have to be a real estate professional. A real estate professional is somebody who is active in real estate, and therefore you can treat real estate, instead of passive, you can treat real estate as active, and therefore there are no limits or caps on the losses. Now, if you're a doctor and you do doctor full-time, this is not true for you, because you are not a real estate professional and you're capped at, I think it's $25,000 of passive losses. That $90,000 that we just showed, that was a passive loss, unless you're a real estate professional, in which case it's not a passive loss, it's an active loss, and you can use it to take it. So how do you become a real estate professional? You have to spend 750 or more hours in the real estate field a year, okay? 750 hours. That's the first qualification. Number 2, you can't spend more time anywhere else. Okay? So what does that mean? That means you can't be a surgeon and you can't do surgery for 751 hours and also do real estate for 750 hours. That wouldn't work. You could do real estate for 751 hours, and then you could do surgery for 750 hours. As long as you spend more then 50% of your time in it, you don't spend your time anywhere else. But let's say you're a surgeon, you love doing that, whatever else. This is true for your tax return. So what does that mean? If you are married, right? If you're married and your wife, or vice versa, ladies, if your husband, this is your wife, she's so pretty, if she has the ability to become a real estate professional and you don't because you filed together, their classification as a real estate professional can help you take unlimited passive losses. So if it's not possible for you, check to see if it's possible for your wife, your spouse, whomever. And that from a high level is how real estate investors crush it on their tax returns and pay way less taxes than the money they actually make, and preserve more wealth and keep more income to go and make more and more investments in. So I hope you guys enjoyed this. If you did, do me a favor, like this video, share it with a friend, tell somebody else who needs to see this so they can start saving money on their taxes, their biggest expense, and building wealth in real estate. See ya.